Banks can't lose money. To replace the loan that loses money, you might have to do 50 deals. We're not making a big return over here. I know you think we're expensive, but we're not making a big return. And as a property person, would you get out of bed for 0.5%? You wouldn't. It's like when you first look at a property deal and you're looking to flip it. If you need a 40% deal, and if you need a 5% sitting on that income and just receiving the rentals, how aggressive do you need to be? So sometimes we'll just go, yeah, the risk is always the same, so we're always going to do this at X rate. But actually, every deal's slightly different. You can then stand back and go, are the risks right? And is the return right? It's not just about the turnover. It's also about capital, but it's also about liquidity. Cash is king. And why is it king? Because it just allows you to live the next day and the next day. If you don't have that cash, then what happens is decisions get made for you. You don't necessarily always need to know everything, but you do need to be able to ask the right questions. Questions are the most powerful things. Despite the fact that we don't want to take too much risk, we do take risk. Leverage is not always a bad thing, but you need to recognize where you sit. You sit at 60%. I'm in the private members club. No one's losing their private plane today. But if you're hustling, you don't have equity, and it is really difficult. There's nothing wrong in saying, okay, we're going to go to 75, but recognize where you're at. You could do the best job. You could build the most beautiful thing, and you could lose it all. Sales market collapsed. What do I do? I've done everything right. I've done it. I don't look down on people for taking leverage. I get it. Either they're super smart people and they feel comfortable with where they're at, or they're inexperienced people and it's the only way they can get there. I'm not interested in second, third, fourth, fifth time. Get it right first time. The biggest issue that I see is when whoever it is, an investor, developer, will
Hello everybody and welcome to another episode of Property People. Today I'm delighted to be joined by Piragash Sivanesan. How are you today?
I'm very well. Looking forward to it.
Yes, well, me too, because we have things in common coming from the property finance space and have also flipped from one side to the other. But before we get into everything, quick little intro. You've had a successful career in banking. But you were once at one point a finance broker, similar to myself, but recently stepped back from the dark side and now director and head of structured real estate at Shawbrook Bank. The team has been set up to enhance its support function for professional landlords and investors seeking larger, more complex finance solutions from buy-to-let to commercial mortgages, bridging loans, development finance, stuff that even I speak to you about because you've got such a breadth of knowledge and you explain things in such a succinct way that I know other people that enjoy working with you as well from your brokering days and through to your lending days. So before we go into all of that and how that's all come about and where you are today, before we do that, it's really important for me to go back, dial it all the way to the days when you were at school. And what type of person were you at school? Were you somebody that loved school, really good at school, or were you somebody that couldn't wait to get out? And did you always think that you would be in property finance when you were at high school?
So what are we doing? We're going back to the 90s for me. And what I'd say is I'd probably describe myself as over-eager, shy, a zest for life within the confines of school. I was in all the kind of sports teams, not because I was particularly good at sport, but I loved the idea of being part of a team, sort of seeing different people with different skills, kind of competing and pulling for each other, in the tough times and the good times. That's something I really kind of enjoyed. And even today, we'll talk about brokerage later, but one of the hardest things about having your own business is you're kind of by yourself, a lot of the time. And I really enjoy that kind of aspect. I was fairly studious. That was probably driven by my parents. They were quite strict and quite focused. They're first generation immigrants, and really education was the way out. So although I didn't know I wanted to do banking or finance, I initially thought at a really young age I was going to become a chartered accountant. Some people are thinking about the really sexy careers out there, and I was kind of focused on accounting. So I did start off, I did end up sort of doing a year at KPMG in terms of my sandwich year. An amazing company, really opened my eyes to what a global corporate can look like. But in terms of the kind of day-to-day work, I was in audit, it just didn't inspire me. So that was the first roads towards doing something else.
So good at school overall, and you studied what at A levels? Did you go to university?
Yeah, so good at most things except for talking to girls. I was pretty bad at that. I'll be honest, but that did improve. A levels, I did maths, English, literature, and economics.
Okay.
I flirted with doing further maths for about 2 weeks and realised I wasn't that smart.
Yeah, that's tough.
And kept to those three. And then I went to Aston University in Birmingham. And what attracted me to that particular course was I did a general management, was the year in industry. And it really opened my eyes and gave me everything was theoretical and conceptual. My jobs involved working in Sainsbury's and paper rounds and working in an actual corporate and understanding the dynamics between clients, customers, and delivery was really kind of eye-opening.
And you mentioned the sandwich year. For the younger folks that don't necessarily know what a sandwich year is at KPMG, what is that exactly?
So effectively, in your third year, which would be most people's final year, you would actually go and work at a company for a year. So you weren't permanently employed by them. You were employed for a year. And during that time, depending on the company, you would have a wide range of experiences, or it could be quite focused. In my case, KPMG, and I worked in the audit in the Birmingham office.
So then from there, you graduate, ready to take on the world, a little bit of work experience as well in the corporate. What was obviously dreams of becoming a chartered accountant not quite materialized for one reason or another. But what was your dreams or ambitions at that point?
To be honest, I just wanted something that I felt like I could add value. Right, even that doesn't mean I need to change the world, but in what I'm doing day to day, is it making a difference? If I'm just ticking a box because a box needs to be ticked, that didn't excite me. So I knew that much. I didn't know a lot, but I knew that much. And so then I looked at, like everybody else, you milk around, you look at all the different types of employers, and I got a couple of banks at that point. So Lloyd's Bank were the ones that kind of eventually offered me a role, and I went on to their graduate program. I was very fortunate. I got to spend 6 months in kind of a credit function, then a year out in Dubai. Really at a time when no one had really heard of Dubai. It was sort of 2004.
Wow, yeah,
and,
definitely early days.
It was very different than it was, say, 30 years ago, but that was amazing because in one building we had every department in the bank. So we had like the treasury, the private banking, offshore banking, retail banking, corporate banking. Everybody was sat there, and I got to kind of direct access to the CEO, country CEO. And just having someone with that kind of strategic input was exciting.
Yeah.
Got to be involved with all sorts of projects over the bank, and it really set me up for, this is actually what I want to do. This is kind of exciting. I ended up finishing up within the area of turnaround. So I spent 6 months there, and that was at a time when the economy was actually pretty good. So the businesses that were going into turnaround were management failures. This wasn't because like 2008 where, the banks are failing or capital's failing or, the general economy is doing badly. This is just pure kind of management failures at different levels. And it was just really interesting to kind of go into these businesses, talk to these founders and kind of go, read the reports, what was going on? This started off so well. And then what was it? So there was one company I remember, he had an amazing founder, but he would sell faster than the rest of the business could cope. So operationally, they were making huge losses because they just couldn't, even though he was winning 10 million contract, 5 million contract, 10 million contract. And so, we brought in sort of turnaround specialists at the time, and you could see that one little thing at the rear end was affecting, because at that age, I'm thinking, well, if you win this big contract,
you're going to
you're going to make money. This is going to be fantastic. And then actually seeing, no, because it's not just about, first of all, the turnover. It's also about capital, but it's also about liquidity. Cash is king, right? In property, right? Everyone at cash is king. And why is it king? Because it just allows you to live the next day and the next day and make your next decision and the next decision. If you don't have that cash, then what happens is decisions get made for you and removed from you. So that was great. And then I got into global corporate banking. Again, Lloyd's was a UK corporate bank. For those listeners, I was involved in kind of the telecoms mergers in terms of kind of O2, Telefonica, all that kind of stuff that was happening in the mid 2000s. And late 2000s. But and I was super excited, right? I've made it. I'm finally going to add value to these amazing transactions. And I remember one meeting, I went with my boss, and we went to meet I think it was the FD of O2 at the time. And I thought, all right, we're going to really talk about the loans we can do and how we can structure something. And he didn't care. He didn't care. He effectively asked us how cheap our balance sheet was. And that was it. And then I realized that actually for them, the most interesting people was not us. It was the investment banks. And it was how they were the ones who were really structuring deals. They were the ones who were creating the M&A opportunities. And we were there really as cheap money. Especially back, pre-2008, there's a lot of cheap money flying around. And so after that year, I was like, I can't, again, I'm back to that situation. Suddenly, I'm not adding value again. I'm just box ticking. We're just putting cheap money out. We're not adding any value. And so I moved after a year to our structured asset finance division or structured finance division, which looked at a lot of, wasn't necessarily all real estate. It was project finance. It was big kind of construction projects. But where there was an element of construction, then there was an element of income after that. And it was looking at all those risks. And it was worldwide. So doing a lot of traveling, got out to Asia, Turkey, Scandinavia. Really, really fortunate to kind of go out to some of these places. But we weren't dealing with big corporates. We were dealing often with people who were very wealthy, but they were the founders. They were specifically the founders. And for the first time, again, I was adding value. Like how, this is what we're seeing in the market. Structuring a loan, going down to the minutiae of covenants. Is it important? Isn't it important? In an environment where maybe banks have got less, got pressure to put money out. And so covenants start disappearing. Is that a good thing? Is that a bad thing? Sitting at, the credit committees at Lloyd's' highest credit committee. And, that's an amazing place. If I can digress, you can always edit this out. One of the guys I probably learned the most from was there was a guy who was head of group credit for the whole bank, and he would see every type of deal, right? So I would bring my little deal that I've spent 3 months learning every single number, every single thing, and there he was making a decision. And then the next to me would be an insurance deal, and the deal after that would be a real estate deal, and the deal after that would be something else. And I just sat there and said, how are you doing this? How are you knowing everything? And he said, that's the point. Because when I ask questions, I'm actually testing whether you're believable. Whether when I shake the fundamentals of what you're talking about, does it still ring true? And if I see nervousness or an inability to communicate the fundamentals when I shake them, so you're assuming oil price at this rate. So what if it's not? What if it's half that? What happens? And if you say, wow, I've no idea, then I know that I can't trust you because you haven't looked at the fundamentals. And it was a really interesting lesson, in terms of kind of going, you don't necessarily always need to know everything, especially in different layers of management once you're at the top.
Sometimes I get
you do need to be able to ask the right questions. Questions are the most powerful things.
Let's say family members that might challenge me on stuff with their way of seeing things, rather than asking me a question going, which will hopefully open with an open mind, create a little bit of provoking process where I can actually overcome an objection or a concern or a risk, rather than just highlighting what can go wrong. It's like, well, I've already thought of that. Or if I haven't thought about that, let's talk it through. And I think through asking the right questions, it is generally the right approach. And I think senior management people that have been in that space a lot kind of understand that more so than anyone, because they've got so much going on that all they're hoping for is responsible people that are passionate about what they're doing to have done that homework. So, for example, if that oil price comes down and somebody's answering it very nervously, even if they're trying to kind of blag it, they might not even say it quite honestly. I don't know. Most people might try and blag it, but he kind of comes through anyway. So that's a really interesting space to be in. And just for those people that don't necessarily know the difference, an investment bank. One person once told me that an investment bank is like a broker almost, where they are taking two companies and merging them together, and then they're finding who's going to have the money. Is it going to be Lloyd's, or which equity house might have the funding for it? And the investment bank, because some people think an investment bank is very much like a normal bank where you leave money, you deposit money and lend money. How do you define an investment bank? I'm delighted to inform you that Property People will be the official podcast sponsor for the Property and Entrepreneur Summit. I went to the last one and it was absolutely brilliant. A room full, packed, property people from front to back, property professionals, investors, developers, landlords, architects, lots of service providers, and an exceptional lineup. And this next one is going to be no different. The lineup has Simon Zucci, Hayley Andrews, Shah Wasman, Jamie York, James Sinclair, and a whole bunch more. I recommend you get involved and inspired by a world of property and business. So if you'd like tickets, reach out to me, DM me, or leave a comment below, and we'll make sure you get the link, and I hope to see you soon.
So, to keep it simple, because I'm sure there's a load of regulatory definitions.
Sure.
But for me, the way I would see it is, consider what return the bank that you're speaking to requires. So if you're talking to a savings bank who's going to hold your salary and is going to pay you 0.3% and they're going to maybe make 0.5% on that, that's their realm of risk, right? 0.5%. And as a property person, would you get out of bed for 0.5%? You wouldn't. So that's where my risk profile, I want things really calm. I don't want to take risk. And then as you go up the risk curve, and as that return changes, so again, going from retail banks to corporate banks, who again, maybe their margins are starting to look at 2, 3%, whatever that is, then investment banks are probably looking for closer to 10, 12, 13, 14%. Now, in any transaction, it's like when you first look at a property deal and you're looking to flip it. If you need a 40% deal, how much more aggressive and creative have you got to be? And if you need a 5% sitting on that income and just receiving the rentals, how aggressive do you need to be? And I think that's, then you can get into complexity of what an investment bank actually has to do to achieve 20% returns. It has to put these two companies together who've never thought about being together. It needs to manage all the people. It needs to probably put elements of funding. It needs to convince other investors to come in. This is going to sound familiar to property people because often they're constantly doing this. It's just investment banks are doing it at an institutional level, and they're doing it in an incredibly professional way. But fundamentally, what are they looking to do? They're looking to charge high fees. They're looking to charge enough returns. They would argue that they create enough value for that to happen. But that's kind of how I would look at the different types of banks. Start with, it doesn't really matter what you call them, but even if a commercial or corporate bank had to get really high teen returns, right, what does that mean? What does that mean in terms of how aggressive they've got to be? But also, sometimes it can work the other way. So if I'm talking to a bank that needs to be aggressive, maybe they're more likely to talk my language. When I'm taking risks, they're ready to take risks because the returns are so high. But if the returns are much more reasonable, the sort of returns that you wouldn't expect to take, right? You're not going to get out of bed for that 3%. But yet you're saying that, can you do it a bit cheaper? But can you also take a bit more risk? But can you do it cheaper? Now, of course, we're all going to try our luck, right? When it comes to funding.
You don't get if you don't ask.
Yeah, well, sometimes you just don't get.
Yeah,
But,
exactly.
but the point is, when it comes to understanding the dynamics between, again, I'm digressing now, but between kind of borrowers and lenders, people talk about property being about relationships. Well, it's the same with everything.
Yeah, sure.
Understand, is it the bank manager that you're speaking to? What are they worried about when they're looking at your transaction? Is it an RM? Ultimately, you're dealing with an employed person in an organization that is probably regulated. What is their mindset? How can you help them help you to get where you need to be? And if you can start with that in mind, you will win people over. I'm not saying you'll always get what you want, but it's a good place to start.
And with operating at that level, and it's quite clear with the way that you speak, so clearly you understand this stuff fairly profoundly. How did you find yourself moving into property finance specifically? And what were the steps that you took?
So, again, during my career, whether it was a Lloyd's or RBS, I had exposure to property finance, did elements. It wasn't the major bit of what I did. So for me, you can break it down to its simplest level, which is ultimately, what am I relying on? Am I relying on the security, which often you are in real estate? And how susceptible is that security to change? Are we talking about a yield style valuation, which the smallest differences view of, for example, general bond rates, interest rates are all going to affect that yield? Or are we talking about bricks and mortar, which is pretty specific, but has a nice anchor in the owner-occupier market, and especially in the UK, right, has a in some ways the supply-demand imbalance means that there is a certain level at which you expect bricks and mortar to always sit at.
Yeah.
And again, I look at it from, and then where is the cash flow coming from? We talked about liquidity earlier on, right? So where is the liquidity? What's the quality? What's the texture of the liquidity that's coming? Who am I trusting that it's coming from? Where are the different layers that it's coming from? What rights do I have? What rights does the borrower have to that cash flow? And now you're starting to build a picture. Well, actually, maybe the first two is tricky, right? The security is malleable. Maybe it's a building like, maybe you take something like office today that's an empty office. So it's the real valuation of that office is difficult for anybody, right, to absolutely get right. And then you overlay that with the income, perhaps, there is no really market rent in that situation. Then I'm looking to my third anchor, which is the borrower. Who are we dealing with? Are we dealing with someone with big pockets who wants us to take a chance? Now, going back to what we were saying before, right? Sometimes you'll have somebody that's super wealthy that's going to turn up and say, look, I'll stick in a load of cash. We want you to just give us cheap money. Come on, bank. That's what you should do. But in reality, the question is actually, is this more of an equity style deal? Because shouldn't everybody who's participating get equity returns? In which case, maybe we're not the right bank.
Yeah.
Right?
Yeah.
And maybe you need to speak. And the reason why you're speaking to us is you don't like the rate that the other bank's telling you. But that doesn't mean that it needs to be. Or if we're going to do it, maybe we need to think about the structure differently. I know it's kind of, it feels like, it's the easy thing, but is there any other security available? Or can we manage between the two?
Yeah.
Is there income somewhere? Is there a corporate guarantee you can give me from someone that is genuinely strong? Personal guarantees, etc. How does it all fit together? And then you end up with a balance, and then you can then stand back and go, are the risks right, and is the return right? We're in an environment where, because of the competition, because you guys are doing your jobs really, really well at home, right? There's huge amounts of competition to win your business. So sometimes we'll just go, the risk is always the same, so we're always going to do this at X rate. But actually, every deal's slightly different. And in reality, certainly I've come from an environment, certainly doing, multi-billion pound deals where you're constantly just checking in to make sure that the risk reward is right, but that the risks ultimately are not wrong. Because the one thing that banks generally, can't lose money. To replace the loan that loses money, you might have to do another 50 deals, 100 deals.
Yeah.
So when you say, "Oh, come on, don't worry about the PG today," or "Can't you just give me an extra 5%?" or "What's the big deal? Market value's this, vacant position's this, or the GDV looks great." Yeah, but what we don't want to do, we want to back you. Of course we do. We love speaking to great founders, great brokers who really know their clients. Of course. That's the best thing about the job, right? And speaking to someone that's an entrepreneur, that you can see their vision and it really makes sense. But what we're saying is, we're not making a big return over here. I know you think we're expensive, but we're not making a big return, right? You look at the market caps of banks, right, since the 2008. It's not stock that I would say generally is a sector that's loved, right? Because there's not a huge amount of money being made. A lot of money's come down. So as a result, what's really important is if you can't boost revenue, you've got to really be consistent in understanding and lending in the right way.
Interestingly, I had somebody that I used to work with. I think they were at ICICI Bank for quite some time, and they had one rule that he told me that was you can lose the interest but never lose the principal. That was like the word. Like you can lose the money, the revenue that you've made and stuff, and the profit or whatever. But if you lose the principal, then that's pretty much the worst crime that you could ever commit as a banker.
Well, I won't completely agree. I don't like to lose the interest or the capital.
No, I mean, if you're going to lose anything, like you can maybe stay in the company if you lost the interest, maybe. But if you lost the principal, you probably excommunicated from the industry, and that was one of the things that he kind of hammered home.
I think the other thing I'd add to that, right, is that look, despite the fact that we don't want to take too much risk, we do take risk. Naturally you take risk, whether you're, especially in the alternative space, whether you're a development lender that's starting to go above the traditional 55% loan to GDV going up to 60, 65, 70, 75, whether you're a mezz lender, all of these guys, even the guys at 55% take risk. One of the main differences between banks that have long history is that they've got the records to prove that if you don't do this, this, and this, you can lose money. So where is the point at where you're unlikely to lose money? It's probably at 55, right? But certainly, whether it's the bank that I work at or if you look at the challenger market, we're consistently trying to take risk, like we are. But it's a real difficult balance. It's why we have so many credit committees. It's why we ask so many questions. I do sometimes love the sheer bravado and enthusiasm of kind of going, well, what's difficult? It's 70% loan to value. It's cash flowing. Just do the deal, But actually, it's in the minutia, right? It's in the little things. They're the things that often trigger something that creates a loss. It's not always in the big bold statements at the start. Otherwise, lending would just all be done by computers. And maybe when we're doing this in 5 years' time.
Exactly. And things might change. So on that basis, because, working as a lender is one thing at Lloyd's. What about the steps that took you to property finance brokering?
So becoming a broker, so I sort of was involved heavily in restructuring from kind of 2008 at Lloyd's to 2010, merger with Halifax, and then moved to RBS, 5 years. Again, a lot of restructuring during that time, and I was really an international corporate banker lending to foreign owners. It really wasn't flavour of the month for UK banks, especially ones that may be state-owned, to really push that part of the market. And so I took my redundancy in 2015, and then I looked around and I thought, okay, well, I'll just apply for something else. And I think at that time, compliance was hiring heavily. But sales originators, I think there was a recruiter that really helped me, and they kind of sat me down and said, look, you're clearly good. You've got good experience, but what you were specifically doing is not necessarily available. And if someone's going to take a chance on you, why wouldn't they look at the rest of their 70,000 list of employees and take a chance on them?
Yeah, exactly.
And I thought, wow, okay, all right, I need to do something. So I thought, yeah, I'm going to do it. I'm going to start my own business. I didn't know what it was going to be, but I'm going to start something. Like I always loved the idea. You know, you speak to so many entrepreneurs, you love what they do. You know, you think, you see the greener side, right? It's like, you know, hugely successful owners, no stress.
Lamborghinis, yachts.
Yeah, exactly, right? I would have probably done with a little paddling boat, would have been cool for me. And I looked at different industries. I looked at franchising. I looked at becoming something called an action coach. I looked at all sorts of different kind of franchise agreements, and nothing really felt right. I spent 5 or 6 days with a friend of mine that's in domiciliary care. That scared me. You know, I just thought, I can't sleep at night. Wow.
Yeah.
You know, taking the responsibility of looking after people, but also managing the costs of, like, you know, the nurses, and having to think about the margins and when you can pay them, when you can't pay them, they can't travel, all this kind of stuff. It's like, okay, I need to get back to what I know, right? As opposed to trying something that I just don't know. And so I thought, finance. Okay, I do know finance. I do think that I've got some value to add. And I first struck up a relationship with a brokerage up in Yorkshire called White Rose. And initially we were having conversations about me kind of maybe being an outpost for them. And then it ended up that I would basically become an appointed representative of theirs. I could create my own company. It would be me. And they were amazing. They were amazing because I would call the office every day going, so how does this brokering thing work? How do we charge? How do we get paid? What do lenders think of us? What are the typical questions in this space? Because while I understood the fundamentals, I had to completely shift, you know, down to almost the SME market, right? And I'll be honest, those first 9 months were brutal. Because I didn't have any natural referrals in that market. So I was literally starting again. I was knocking on doors. I was turning up to people like Brendan Quinn's events, you know, saying, hi, I'm Piragash. I do know about finance. I'm new, but I know about finance. Can I help you? And very soon what started to happen was I started to work out, right, that actually, was I the best networker in the world? Probably not. But if you could get me on stage, I could probably open up an understanding for somebody. And that was my value add. That was my in some ways. So that's what I started to do. I started to try and figure out a way I could get on stage and start speaking to people. Some very kind people who hosted different events allowed me to speak. And that was the start of trying to do stuff. But again, I've got a family, young kids, and my redundancy money and savings is going down. And, you know, I'm a fighter, right? The one thing I won't, you know, I'm not quite, to reference different social media person, I'm not quite Andrew Tate, right? I won't say I'll outwork you no matter what, but I do believe in hard work. So I got to the point where I was kind of like, maybe this is not going to work. Maybe I need a part-time job. So I trained as a security guard.
Oh, wow, did you?
Yeah, I got my little card. So, and I was thinking I wasn't really going to be a bouncer. I don't think I'd be very intimidating. But I was thinking I could get some construction work or whatever on the side. And I spoke to one recruiter and he goes, no. Your English is far too good. No. All of our guys are either Polish or Indian or whatever. And no, you're going to be ostracized. No. And I thought, come on, I can't now even get a job as a security guard. And I'm trained up. And in that low moment, right, you need people in your life. And I have to thank my wife. She sat me down and she kind of went, you're good at this, right? We believe in you. I know things are a bit scary, but do what you're good at and prove people right. And I sort of doubled down on what I was doing. I was going out And then towards about 9-10 month, it was actually a couple of guys that I used to go to school with at sixth form. They had businesses and they gave me a chance, and they were the first loans I did. And then I got into development finance and loved it, because your ability to be creative. I mean, right, in terms of mayors funding, equity funding. You've got lenders that were just entering in the market, so they were working out what they could and couldn't do, and there were new lenders all the time. It was just a really cool time to be part of the industry. And so, and so I sort of went from there. And initially it was, just me for that first year, and then I became FCA regulated directly and kind of set up on by myself, really.
And you had a lot of kudos as a broker. You mentioned networking, and I remember when I wasn't actually brokering at the time. I was just starting to get into lending actually towards that time.
We're like trading places.
We're very much so. Yeah. It has been a bit bizarre actually to see how us kind of move around, shuffle around like musical chairs. But I remember everyone used to always say really, really positive things, and actually you had quite a few high-profile on circuit investor developers that would work with you as well and would vouch for you. So when everything seems on the outside going such great guns, and you've got some great clients, and everyone's saying great things about you, I think everybody did. Certainly the people that I know kind of took a gasp of like, oh my God, why would you stop doing what you were doing? And you I've spoken to you privately, and you said we did have some really good success along the way. Of course we did. Look what we did. But you decided to put a stop to it. And so tell us how that process went.
So what I would say is, well, first of all, thank you for the kind words. I think, there's a difference between offering a service, adding value, and running a business. And the things. What are the things I love to do? I love speaking to clients. I love structuring deals. I loved executing, and I love being paid. Right? Probably, maybe not in that order. Maybe reverse order. But the one of the hardest things for anyone running their own business is, especially in that first couple of years. I was the telephonist. I was the IT manager. I was everything. I was the marketing manager. You're trying to do every single thing. Compliance. You're speaking to the FCA now. So, and I think I sort of muddled through it. But if I look back, to keep it brief, I would say the thing I really struggled was creating proper systems and processes that allowed, so that I was really building a business beyond a consultancy. I think I was probably a very successful consultant, self-employed consultant. I did bring in people from time to time. So on my first iteration, brought in, I love all these people, right? They were all part of the journey, but really young guys, who maybe didn't always have the experience. And then as soon as I switched off to train them, the business just wouldn't move forward, right? So some of that was recruitment, some of that was the experience, some of that was the fact that maybe I should have had a load of systems and processes before hiring that first person, or maybe my first hire should have been a systems and process person. There's lots of different ways to do it, but I think the only way you could manage the way I was managing was probably to have really experienced people. Because if you've got a bunch of really experienced people, they can kind of get on and just do the job, without always needing support or way of training. And I think, so that first iteration kind of petered out. The guys went on to different things. And then just after COVID, had a decent couple of years with doing the CBILS loans as well. It was quite good for developers. And
it was good times, the CBILS loans for developers. I know a lot of them benefit from that.
Yeah, absolutely. I still think the government did the right thing. They were boosting construction, all of those things. I think it was needed. But from a broker's perspective, it kind of suddenly boosted the amount of funding that different people needed. Coming out of that, I probably built a cash pot of circa, half a mil, maybe 600 grand. And I thought, right, what do I do now? And I wish what I'd actually done is just sat down, listened to your podcast and listened to all the experienced people and started investing in property. But instead I thought, no, I love this business and like our brand's good, like all I need is really experienced people. So I brought in a number of people who, to this day, I would say are all excellent, really, really good people, and have gone on to do some fantastic, fantastic things. But whether it was just past COVID or what, there was a burn rate. All of these people were well paid, and we just got into a burn rate situation where there were no sales. After like 9-10 months, there were no sales, literally no sales, and it was, at that point, it was like, oh my God, and from my perspective, I'd done turnaround, back in the day, right? I'd built loads of models, and this is the thing about models, right? So I'd built loads of models and worked out now, surely no one is going to get to the point of like 8 months and no one's done any deals. It's impossible, right? And maybe what I should have done is said, that's impossible, but what if, and what do I do? And do I place early triggers for all of those things? And that's,
early triggers for all those things.
Yeah, early triggers for all those things. So actually, if 9 to 12 months is a cutoff period, do you then go back to month 3 and kind of go, in the recruitment process, you kind of go, I kind of need you to be hitting X by month 3.
Yeah,
right?
exactly.
Because one of the things I also, and this is the difference between business and what you want to do and lifestyle businesses. But I didn't want to build a business where the brokers were self-employed and they were, waking up at night wondering how they're going to feed themselves, to put food on the table. I just wanted to hire great people, pay them well, and see the results. But again, my mistakes were in, that's fine, but you've got to kind of take a couple of steps back and you've got to kind of go, where are the early triggers? And ultimately in business is unforgiving.
Absolutely.
If you're doing well, it's fine, but if you're not, and look, in the end, I went through a process and I got rid of everyone. And then I got to a point where I was kind of like, I was exhausted, because I had given it my all to try and help, to try and make things happen. And it killed me inside. This was a business I loved. I loved the freedom of being able to wake up and kind of going, I want to go after that client. I want to do a bit of social media work. I want to go on holiday for a month. I want to do this or that, right? I loved being a business owner. But at the same time, I just got to a point where I was like, I'm exhausted. Could I go again? I could, but I needed a break. I needed a way to kind of rethink my thoughts. And also at that point, I thought, what I should do? I should go out to a couple of lenders I know. Let's see whether they even want to bring someone like me, who's an ex-banker, who's then a broker, and then, maybe they're going to go, sorry, you're unemployable now. There's just no way. And then that's when I first went back to UTB. And I kind of made that jump, to kind of, so that's the story, really. It took a little while. I mean, I took probably about 4 or 5 month break before I started at UTB. And really that was about kind of, it took a while to kind of get over the feeling that I'd failed, because looking back now, the way I look at it is, yes, I've learned a lot, but ultimately I went for it. Sometimes you win, sometimes you lose. Definitely I lost on this occasion, but I'd still make the same decision. I'd just do it slightly differently.
Love that story. And I think it's it's important that people know that taking risks, whether you're in business as a finance broker or in property development and investment, that's where we just had a guest earlier today. That's where the biggest growth comes from. That's where the biggest learnings come from. If you don't risk anything, that's the biggest risk of all. And to say that you don't regret any of that, other than maybe I would have done things slightly differently, I think is a true testament of somebody that really, really enjoys what they're doing. And you're in the right industry, you're in the right space. Because if you want to, like most people, if they've really been scarred, they've probably run a mile from doing anything like that ever again, would have a very, very different comment. But the fact that you want to do it again, or you would do it again, just slightly differently, is also a bit of wisdom as well. Because, why would you do it exactly the same? Now, And I think for me personally as well, that's the way I see things as well as, as much as I want everything to go through over a longer period, you look at your cash flow forecast, you look at your runway, you do your projections. And what I've learned as well is having those earlier triggers, as much as it's painful, and you build up good relationships with certain people as well, but it's just not quite working for whatever reason. Just got to pull off that Band-Aid and live to fight another day, which is easier said than done, that's for sure. Anyway, so now that you're back being a lender, so what are because when I was in my lending days, and I told everyone that I was going to be a broker, they were like, "Oh, you're moving to the dark side." Dun, dun, dun. Star Wars theme tune starts to come up, and they're like, "So, is it true that lenders think all brokers are stupid?" This episode is sponsored by the PLMD Group. PLMD Group is made up of the PLMD Development, PLMD Estate Management, and PLMD Capital, providing expertise in real estate development combined with asset management. With more than 70 build-to-rent properties and £20 million of assets under management, PLMD's extensive knowledge of local planning policies have resulted in a strong track record, turning liabilities into valuable assets. The group delivers value through a fusion of experience, innovative design, imagination, hands-on management, and sustainable resources. To find out more about PLMD and the services they offer, head to plmdgroup.co.uk. Or not as intelligent?
I mean, look, having sat on both sides, I personally, I mean, I can't speak for the whole industry. I would say the most powerful thing you could point to, right, is that the intermediation of finance in this space is costly for banks. And if they could replace brokers, they would have done it a long time ago. But the fact is, brokers have an ability to network, bring in deals, understand the client that has gone beyond what, at least in the challenger space or in the mid to lower SME space, banks just aren't able to do. Otherwise your natural BDMs team would just go out direct and just kill it, right? And the ever increasing nod to intermediaries is the fact that actually there's a whole bunch of intermediaries that do a great job. I think there's always going to be a natural tension, right? Because in reality, and I used to have this as a broker, people used to go, "Oh, I love your packs. Absolutely love your packs." But they wouldn't pay me any more for it.
Yeah.
Right? So what are you actually valuing? Are you valuing the introduction, the physical introduction, just the introduction, or are you valuing the work that goes with it? Now, again, different lenders will have different brokers on different pedestals as to what that means, whether it's volume of business is important or quality of business is important. So, do I think brokers are stupid? No, absolutely not. Actually, most of them have very nice lifestyles, work very, very hard, play hard, win hard. And, in many ways, sometimes, well, certainly me, I envy what they have. But I think what we also should recognize is that any relationship, it's about making sure that you are both clear about what you both value. So if I value, most importantly, a pack or a deal schedule or overview that really covers all of the details, or if I value the ability for an intermediary to have that difficult conversation with a client in order to move things our way, or is it that I value most just the introduction, or is it that I value... So I think that's the first thing. Do not expect brokers to be lenders, because they're not.
Yeah.
Right? So am I expecting the same level? But I think expectations need to be set. So, for example, if I'm looking at a 25 mil plus deal, ideally from the outset, I'm going to say, broker, thank you so much for this introduction. This is great. But for me to really underwrite, really get under the bonnet of this, I'm going to need lots more information than you've initially provided. The real question is how do we best go there together? Because I know you want to protect your client. I also know that you need to be value adding throughout this process, right? I know the value you've added to us by introducing, but you've also got a client there. So how do we best do that in a way that helps both of us and ultimately always helps the client, right? And I think once you can have that grown-up conversation early, like, look, I'm so glad you've got this 25 mil deal. And I know it's big commission for everyone here, right? And it's big kudos for us. And obviously we'd love to do a big deal. But that big deal comes with extra scrutiny. It comes with extra pressure. It comes with more competitors wanting this deal. It comes with, so let's get it right between us two about what we think this relationship is on this project. And I think genuinely, if you're having a really clear conversation at that early stage, generally you'll be fine. I think where things get difficult is, oh, but this bank always does it this way, and now you want this. Oh, what are you doing if I'm gathering all the information and you're just inputting it? Or how can you possibly expect me to do this deal? There's a level of complexity. I know I said yes 3 weeks ago on a AIP, but that doesn't mean that I'm going to be able to do the deal because now you're giving me more information. So it's kind of like we're always optically in a different place, right? And I think having that early conversation just says, okay, right? We're a team now.
Yes.
Right? I know what you want and you know what I want. For me to get to this place, and by the way, this is the best that I think we can do. Oh, but why can't you just be cheaper? I can't. This is what I can do.
Yeah.
But if you want to go somewhere else, that's cool. All I've done is we've had a great conversation. Yeah. I've done maybe a couple of hours of analysis. If we need to part ways, that's fine, right? We'll hopefully we'll do the next one, right? But I can only ever do what I can do, and it's just. But can I help you? Actually, I know this bank maybe is interested in a deal. Maybe you go speak to them, right? So I think we've always got to respect each other because we need each other. Because I think if intermediaries didn't exist, banks wouldn't do as many deals as they're doing.
It's a collaboration. It really is, and it's true. Well, the way I see it is, which is what it is effectively. The brokers are an outsourced function of deal origination. And they do that for cost benefit, right? So we'd only pay for the deals that we know that are going to go through. Otherwise, we don't want to have just loads of... And they do have internal BDMs that are out there chasing, but then they're not chasing the direct to consumer. They're going via the brokers because the brokers are doing a lot more of the relationship building and hopefully doing a lot more of the filtering so that they can actually place deals correctly with the right lenders, knowing what their appetite is, etc. So I've through conversations here and there, it seems like sometimes by the time a deal arrives to a lender, and then the lender takes over, there's that initial conversation, but then the lender has to do all the underwriting and credit process, valuations, legals, through to the end. And of course, if you've got a good broker, they can actually do a lot of hand-holding through that process. Sometimes the lender can think, all they've done is pass us a name and number and maybe a couple of sheets of paper here and there. And that's all the work that they've done. But they don't necessarily see everything else that's gone before it, all of the extra hand-holding, all of the extra just consultation.
To win the client.
Just to win the client, just to win their trust, just to be able to say that, we are going to run with you no matter what, which sometimes I think for less experienced lenders, at the very least, can be a thing. Just going back to now the concept of actually where you've gone from being employed to being self-employed and then employed again, and some of the differences and pros and cons. For some people, it goes back to also, it's quite interesting because some people can't be a broker. I've tried brokering and it's like, no, I've got to be a lender actually. And some people have tried lending and they're like, no, actually I much prefer being a broker. Same with self-employed and employed. Some people are just not suited for one or the other. And with somebody with your unique experience where you've literally tried both sides, let's start. I want to talk about both. I want to get your insight on both. Let's start with employed and self-employed, what are the pros and cons that you've felt whilst you've been either employed or self-employed?
I think, self-employed are all the things that people imagine, when they think about being self-employed, just freedom, the freedom to carry out your day and to have no one but yourself and maybe the P&L at the end of the day to kind of talk to or have to speak to.
Answer to.
Yeah, that's what I was looking for. So, that is incredibly compelling, but it comes with huge stress. It comes with loads of negativity around everything else that you've got to do in the day. Sometimes there's someone that I know that's started a business recently and just completely ignored the compliance element of it. Just wasn't into it, reading 60 to 90 pages of compliance stuff for their business. And it's come to bite them.
Oh, shit.
Really difficult, and it's kind of like, because you have to think about the legal framework. You have to think about, you have so many things about running your own business. But for all that, I think it's worth it. I think it's a great ride. I think being employed, obviously, the obvious one is that you get a regular income, right? The certainty of pay, being able to plan, sit down and think about your children's birthdays and their ever increasing cost of presents. You can kind of go, okay, this is how I can pay for that. But actually, the one of the best things about being in a great organization is being in a room where everyone is smarter than you. That's awesome. For learning, for being pushed. I love, sitting in a room, whether it's a credit committee or whatever, with like the senior guys in the bank, seeing how they lead the team, seeing how they may structure something, seeing how different ideas, or someone super senior in the legal department, just churning out these little gold nuggets of things I didn't even think about. That is hands down, I think, for me, the best thing about being employed. Yeah. If you work in a great organization and you've got people that are smarter than you, you get to learn from them. Like, what better thing to do? One of my problems with Totem when I had Totem was, I'm not saying I'm that smart. Yeah, I never did the further maths if we go back to it. But I was often the smartest person in my organization. And that scared me because although I loved the work that I did, I probably didn't learn that much new stuff. Yeah. In terms of from a business perspective, yes, but not from a finance structuring perspective. So yeah, just kind of, they're the things that kind of stick out.
And then from a lender or a broker, it's funny, I'm thinking about one person that went to Lend Invest. She's tried to be a broker and then she's like, no, I need to be a lender. And for me, it was so abstract because I actually really enjoy being a broker. And it takes me back to my early days of being an estate agent, which is effectively brokering. And I right now, especially where I'm at, I just can't imagine myself being a lender again. I really enjoy being able to say yes to most people that I can help you in some way, shape, or form. I just don't know which lender it is right now until we talk it through. And even then, I'm going to have to do a bit more research. But that's my job to do that. But I can say yes to you. Whereas as a lender, I just felt like I was saying no all the time, or like more often than not. Or when I could say yes, I'd be competing with other lenders, and I just hated not being able to do that. From your perspective, the pros and cons from being a lender to a broker, is there any aspects of being a broker that you miss?
I think you've hit the nail on the head, right? The thing about being a broker is that when a project comes to you, you get to create, literally you have the universe, right? which could be a complete equity solution on the other side. It could be, a combination of debt and something on the other side. It could be tearing apart the deal into two different tranches. It could be dipping into one lender and then going to another lender in order to provide the solution. You literally have the toolkit, right? Everything, all the tools, the hammer, the sword, the spanner, everything.
Every weapon in the arsenal.
Yeah, yeah, exactly. So that's the most, intoxicating thing, I think, being able to really deliver. Now, from a lender's perspective, it is different. It's I don't want to say it's more grown up, because that's not right, but it's kind of a more nuanced position. It's being conscious that yes, you have a range of solutions, but they may not fit the borrower. So the skill there is very quickly not knowing that there is a solution, but knowing whether your solution fits with the client's solution. And also, what's often great is where the client and the broker maybe think that you're not the solution, but actually you can meld the organization, often by annoying people, but nonetheless, and getting to where the borrower and the broker needs you to be. So it is possible, but it's a much more narrow. You're just working with a hammer, basically. But you can still mold something, and sometimes the buzz of that is even higher, because all of the different obstacles you've had to overcome to kind of get there. But also, again, going back to the smartest person in the room. The other thing about a larger organization is there are other people to help you kind of navigate and create a solution. And that can sometimes be quite a positive when you're a lender versus somebody else. But I think it's kind of like, hopefully I won't get cancelled for saying this, but it's kind of like being a very attractive person, right, in a room. The fact is, you know what you want. And so you just simply have to be very clear about it. You get lots of attraction from lots of different people. But if you're very clear about what it is that you want, then it can be just as fun.
Yeah, I agree. And about being the smartest person in the room, I must admit, when I was working as a lender, the guy that I worked with was super, super duper smart, and I learned a lot. And it was great from that point of view. So I think being, I think it's horses for courses with this stuff, and some people like certain shade of grey, and some people like, something different, and it is what it is, and everyone hopefully fits into wherever they feel more comfortable and excel, and that's the kind of hope.
The one thing I'd say to anybody is, I personally, I hate boxes. I hate someone saying you can't do that. You won't be able to do that, right? I hate that. That's like a Red Bull to a rag. But for me, it's more, if people have gone into brokering, sometimes it's just not having a feel for what that really, because again, from the lender side, if I'd never been a broker, again, deals just come in, they just give a piece of paper, a number, and then they get paid, right? That's it. They go out and network. They're on social media all the time. It's a great life. Okay, I'm just going to do that, and all the deals are going to come in. And then you go, no, it's not coming in. But as long as you recognize that there are very few easy jobs out there, right? And so whether you want to be a lender, whether you want to be a broker, it's just knowing and giving yourself. Like when I first became a broker, I gave myself 12 months. Right? I could earn nothing for 12 months.
Yeah.
And it's fine, right? But that's I'm going to go for it. And it was hard, but there was never, there were moments I was like, I have to train as a security guard to see whether this is going to work. But I never doubted, not being able to do it. So I think that would be, if anyone, if there's any lenders who want to be brokers or brokers who want to become lenders, I think, there's nothing stopping anybody. It's just, you got to have the right mind shift. Like when you go to become a lender, don't expect sudden freedom in everything that you do, because there's an organization that has a brand, that has all the kit that you need in order to succeed. So there's a cost to that. You can't be completely autonomous. You've got to understand the culture, and that's where culture fit's really important as well. Depending on the lender that you would go to.
So with the investors and developers that you've worked with on both sides, being a broker and a lender, what are the biggest mistakes that they make generally, in your opinion?
Hindsight's a wonderful thing, right? Hindsight is a wonderful thing. I think probably goes back to the biggest issue that I see is when whoever it is, an investor, developer, landlord, will put a project forward and they understand how much money they're going to make, but they don't always stress. And if they stress the situation, they stress it to a point that it's comfortable. So of course, right? And let's go back to me. I'd stress to 7 months. I hadn't gone any further than that. The real question is, at what point do I bleed? Am I comfortable, if I bled, that I'm comfortable with the outcome? If I'm taking on a loan, am I comfortable that my PG could be called in? Am I comfortable to lose this deal? Am I comfortable to lose the equity that I initially put in the deal? Am I comfortable that my credit rating is going to go? Am I comfortable? Okay, so now we're in the realms of it is possible, right? Because you got to stress everything to the point, and then you might go, well, that is virtually impossible, so I'm comfortable. Or you then say, right, but just in case that was to happen, where's my early trigger? Now, banks have covenants and stuff like that in, but you should have, if you're a developer of Atlanta, you should have your own. So, for example, if you're going to be building out something that's going to deliver in the next 24 months, so something we've seen over the last few years. Back in 2015, when I was a broker, no one was doing pre-marketing really in the smaller space. Now everyone's got videos done and CGIs, and there's virtual stuff done because what are you trying to do? Yes, if the sales market hits a certain rate, that's fine, but if it doesn't, that could be a problem, and where is your early contact with that? That could be early sales, early interest. Actually interest is falling off.
Yeah.
Actually, no one wants to pay a deposit money, no one wants to exchange. Actually, people are worried about their mortgages, and you're getting that constant feedback, and then you can kind of track that and go, right, I'm still 18 months out, but now I'm starting to get that feedback that I was worried about, and now it's coming in. So what can I do now? Okay, how do I maybe change this scheme into holding 50%? Is there somebody that would buy this off me now, like a housing association or an RP provider, right? What are the other ways? Do I need to think about getting extra planning in here in order to kind of make this more profitable? Am I worried about, the bank? The bank's sitting here at maybe lower than their cap. Could I maybe go to them with an extra contingency? Or instead of an extra contingency, extra sales period, right? To allow me extra. So I'm starting to think about it already, and I'm super prepared. And now, as a banker, this guy's, we believe in the plan, right? But he's getting constant, or he or she is getting constant feedback on the project. And so they're able to then articulate to lenders, love that. I know we're not your favorite people after the loan has drawn down. You don't want to have dinner with me fortnightly, right?
Not fortnightly, but a clothing dinner I always insist upon.
Okay. So, but having regular contact.
Yeah, regular contact is so important.
It's so important. But also not just that we're having that contact, but that you're demonstrating. If it's a larger bank, they want to see that you've always thought about this stuff. Have you got the right people in place? Actually, we're going to be making some changes. You don't need to tell the bank that, but actually informing them tells us, okay, you're really thinking about the team that you're putting around, and you're just informing us that you're going to be changing this person, and maybe they're not one of those important people that we would need to covenant. But even if you were to say, right, I've got an extra person now on focusing on sales, because I can see the market as is starting to slow down a little bit, so our focus is that. Then even if economic factors are like, I don't know, one of the big values comes out and says, look, we believe value is going to fall, mortgage is going to be more difficult, we're forecasting interest rates going up, not down. Then you can imagine in a bank, what happens is, from a portfolio perspective, we're constantly reassessing what's happening. What could be the loan that could have difficulty? What loan, who do we need to speak to? And then there's this loan, which is, let's call it Sam Lowney's loan, right? And it's like, it's red. Oh no, we've got to, and then next to it, it's like, Sam approached us already. He recognizes all the risks in the market. He's already starting to do X, Y, and Z, and he'll keep us a quarterly approved. I'm sorry, but there's a world of difference at how you're going to treat Sam in that instance versus treating someone that just doesn't communicate, that feels like the loan's there.
Yeah, sure.
Unless there's a covenant issue, I don't want to speak to somebody. There is, it's the softer stuff. It's hard. It's hard. All this stuff is hard. It's extra because it's not like you're not busy thinking about the project, thinking about everything else you're doing. But it's these things really.
Yeah, certainly. I mean, one of the things that I sometimes see is that, very rarely, I'll be honest, because especially with the people around me anyway, because I always communicate, don't bury your head in the sand. No matter what it is, no matter how bad it is, speak up, let me know about it, share it. How bad could it be? And if it is, no matter how bad it is, at least if it's all out in the open, we can all be solving for it together and kind of having a little bit. But if you're kind of just carrying it on your own shoulders, it's only going to stress you out more, and it's only going to make your relationships with everybody else worse, and they're going to be a lot harsher on you. So let's just keep that communication going. Always pick up the phone. Stories of over leveraging, horror stories. Do you have? Well, I'll tell you. So recently, with the interest rates going up over the last year and a half or so, ICR's interest coverage ratios have been a bit more challenging for buy-to-let loans, for example. So I found some, and then GDVs might have slipped a little bit as well. So whatever was underwritten 18 months ago, anybody that was leveraged up at, let's say, 75% LTGDV, the max they can borrow on a term loan because they can't exit, because they can't sell the units, they may be stuck at 65, 70% LTV on an exit. So they've always got to put a bit more money in. I've noticed that's a little bit commonplace, more so than I'd care to admit, but it is just a way of the world. It's just the way that the market's gone, and those people that made those decisions 18 months ago are getting caught short. Have you come across that sort of thing of over leveraging and kind of how? And like, I've got some people that are like, especially maybe the older generation, absolutely swear by, you should never go above 65% LTGDV anyway on debt. Like anyone that goes to 70 is crazy, never mind 75. What's your take on that sort of thing and risk?
So, if you look at the established players, right? If you go out and look at any of the quoted house builders, etc., the leverage is not high, right? They're often over-capitalized, right? They're equity-driven. Then you look at the medium national house builders. Again, you're going to look at typically 55, 60% leverage, right? They're not over-leveraging. Why? In part because these businesses have built the right to have equity. So while I understand, it's a bit like, a baby boomer saying, well, son, you really should have bought your house by now. The fact is the world, getting on the property ladder, being someone starting a portfolio today, whether that be in commercial, resi, development, right, is not easy. Now, the grey hairs are right. Of course, you shouldn't. But, if you spoke to someone like, say, Philip Green, right, he made his money using leverage, right? But timing also meant that leverage was the thing that brought him down. So leverage is not always a bad thing, but you need to recognize where you sit. So if you sit at 60%, okay, I'm there with the big boys. I'm in the private members club, and we're all cool. Yeah, no one's losing their private plane today.
Yeah.
But if you're hustling, right, and you don't have equity, and it is really difficult, there's nothing wrong I don't think, in saying, okay, we're going to go to 75, but recognize where you're at. You're so far up the risk curve. And just because there's a number of lenders ready to lend at that leverage, and I'm talking about 75 being certainly more in the dev space as being particularly risky. But once you're there, as long as you recognize that, then you can start to do what we've talked about, early triggers. How do I protect myself? So for example, let's just say you're bringing investors into a situation where you've created a 75 80% loan to GDV situation. If it all goes fine, we're all good. But the first thing you've got to do with the people from the top to the bottom is understand, if something goes wrong, what do we do? So the guys at the top, the investors, they're the first ones that when you bring them on board, it's so important that there's a guy that I know who does it incredibly well when I was a broker. And I marveled at his ability to communicate with the investor such that this is property. Nothing runs smooth.
Yeah.
So if you're going to invest with me, you need to understand that. Nothing's 100%, and you might have to keep your money in longer than you expect. But this is what I've done in the past, and so I hope I'll always manage to keep you whole. But sometimes I may even come back to you for more money to help the situation. Are you that in tuned with me, or is this all of your life savings and that's the end of the world, right? So even having those so there was a situation where, again, things got delayed, but I marveled at him sitting down going, can you give me an extra 100, 200, 100? They just went, yeah, of course. Because they understood what they were buying into. I think the issue is, and then going back to the borrower, just because something's possible doesn't mean you should do it, right? And this is where having a really good broker is important, right? Because, as banks, we're not really there offering advice anymore. So, the advice piece is to kind of go, okay, yes, I can do this. Of course, I'm a great broker. Yes, I can do this, right? But just because you can doesn't mean you should. And this is the risks you're taking on. Does that make sense? And some of it will be completely out of your control. So if interest rates doubles, that's outside of your control. You've got nothing, you could do the best job. You could build the most beautiful thing and you could lose it all.
On time, on budget, but it's for nothing.
Yeah. Sales market collapsed. What do I do? I've done everything right. I've done it. And it's that. So it's the power of leverage. I don't look down on people for taking leverage. I get it. They're just, either they're super smart people and they feel comfortable with where they're at, or they're inexperienced people and it's the only way they can get there. So I think the key thing in those instances is to be very focused and understand that you are at a higher risk curve. And when the next person says, I'd never borrow over 65. You say, absolutely. I've just got a higher risk tolerance. I completely understand where I am. So we're all good.
As long as everyone's aware of the situation. Yeah, and exactly. Everyone's got their own risk profile. So it doesn't, I don't think there's a should or shouldn't. I think it's just understanding that the pros and cons of it all, really. So with all that said and done, throughout this career that you've had through finance and property, what's the best piece of advice you've had along the way?
Probably, there's probably two, right? One of my early bosses who used to hit me over the head quite a lot.
Literally? Or?
Yeah, that was the benefit of being always in the office and not being on Zoom or Teams. Was first time. Not interested in second, third, fourth, fifth time. Get it right, first time. So I thought that sort of stuck with me. And the second one was, whatever you do it with shock and awe. So if everyone's expecting average, be amazing. If you consistently amazing, and this is what I found, that becomes your brand without trying it on an ad hoc basis. And for me personally, I love it because it sticks with me, and I think it's great.
And what's the worst piece of advice that you've had along the way?
The worst piece of advice is probably the opportunity is not there for you. Opportunity is not there for you. Look elsewhere. That was the worst piece of advice I've ever had, and and it's so counter to how I would view life. Sorry, but since we're doing quotes, the one other one I would add is good one is this too shall pass. when I've been in really difficult situations personally, when the business was in a tough position, sometimes be able to breathe and just saying, this too shall pass. Life is never like this all the time. That's pretty good advice.
I think Winston Churchill says, if you're going through hell, just keep going.
Yes, love that.
And so this is all about property people. The name of the podcast is Property People. And you're obviously a successful property person. What traits do you believe are necessary to be successful in property?
I would say turn up, be on time, and do what you say. I think if you can do those three things, 9 times out of 10, you'll be successful.
Piragash, it's been an absolute pleasure. Thank you so much for joining us. If people wanted to reach out to you, find out about the funding that you work on, pick your brains for anything, what's the best way that they can get in touch with you?
So 2 ways, LinkedIn. And if anyone has kind of deals that kind of sit within my world, 5 million plus residential commercial investment, then they can always email us at sre@shawbrook.co.uk.
Happy days. Thank you so much. And we'll hopefully catch up again and do it next time, diving a little bit more into detail about the market, the economy, and a whole bunch of other stuff that we didn't even get time for this time around.
Cool. Thank you. Cheers.